Hi guys, welcome back to Father and Son Investing. We talk about bonds a lot on this channel, probably a bit too much. I definitely do not want to be known as the bond king. In today's video, we're going to back up just a little bit, take a little wider view, and talk about how to go about picking bonds or a bond fund, or essentially trying to build a fixed income portfolio. Now, I'm a little reticent to just say fixed income because I don't want all of the younger people here to just be turning this video off. Having bonds within your portfolio is really good for anybody unless you are in your teens, in which case really having all of your money invested in the stock market is probably going to give you the best gains. Today we're going to talk about how to build a bond portfolio and just take a step back. We're going to discuss 4 steps that you would take in order to pick which type of bonds you would be interested and which type of bonds would be best for you in your current situation. Now, before I get to today's topic, though, I have to tell you what a financial nerd I have become over the last few years. Recently, I was riding in the car listening to CNBC. My wife was in the car with me, and I heard this voice come on the radio.
Yeah, absolutely. And, this may surprise me. I'm calling for a 75 basis point emergency cut in the Fed funds rate.
Immediately, I said to my wife, "That's Jeremy Siegel, one of the professors at the Wharton School of Business." I had to laugh because the fact that I knew who that voice was really told me how much of a financial nerd I've become. Let's get started. When I was in the military, we used to use a term BLUF. B-L-U-F. It stood for bottom line up front. So I'm going to give you the bottom line up front here. I'll give you the 4 steps and then we will discuss them in depth. The 4 steps are: define your goals, then choose an allocation based on those goals. You're going to then determine the timing and risk, and finally evaluate and get invested. Those are going to be the 4 steps, BLUF. Let's talk about step number 1. On occasion, I have people asking me what might be the best investment for their money right now. And the immediate answer to that should be, what do you want to do with the money? What is your timeline for the money? What is your goal for the money? So let's just talk about that a little bit here. Here's some examples. Perhaps you're just looking to preserve your investment, to protect it. You're not necessarily looking to make a big gain on that money. You just don't want to be losing money. Well, in that case, here are some products you could consider: short-term CDs or certificates of deposit, short-term treasuries, those are treasury bills, short-term investment-grade municipal or corporate bonds. If you're not sure what those are, we did an excellent video on that recently, and we'll leave a link to it. Short-term bond funds you could also consider. So that would be a way of just protecting your investment. What if, rather than just protecting your investment, you want to add some income to that investment or balance out your portfolio? Well, then you may be getting into some intermediate treasuries or agency bonds. And what if you really want to add or generate more interest income from your money? Well, then you may be looking at other types of bonds, which we will be discussing later. So the big take-home point here is, if you don't know what you want your money to do, it is very difficult to make a plan for investing that money. The next step in this process is to choose an allocation. Allocating your investment simply means that you're going to be picking how much of each type of investment you feel comfortable with. For instance, in a conservative strategy, you may have 50% of fixed income and 20% in equities with 30% in cash. That would be conservative. On the far other end would be an aggressive strategy where you have no fixed income, 95% in equities, and 5% in cash, just in case you see a really great deal in something that you want to purchase. In between here, you can see variations on the spectrum. The moderate aggressiveness here tends to follow that 60-40 rule that you may have heard of: 60% equities and 40% in bonds and cash. I'll let you stop the video here if you like, so that you can read each of the captions below each of these categories to get a better feel for what these investment strategies look like. The next step in our 4-step process is to determine your time frame and the level of risk that you individually are comfortable with. What am I talking about here? In the first step, essentially, we determine the why. What is the purpose for saving or investing this money. In this step, we're partially determining the when, meaning the time frame. When do you need this money? If you need this money in 0 to 4 years, that's different than if you perhaps need this money in 10 years. So we need to determine when we need the money, and that will help determine our level of risk as well. There are actually two types of risks that we want to be considering here. One is interest rate risk and one is credit risk. Let's first define interest rate risk. That is the risk that the value or the price of your bond will decrease if interest rates rise. That certainly has happened to most individuals in the United States if they held their bonds prior to when the Fed started this recent interest rate hike. They have seen the value or the price of their bonds just plummet. So in this instance, you're going to be considering what might interest rates look like in the future. Do you think that interest rates will be decreasing? There certainly is a Fed hike coming. Whoops, make that a rate decrease. Or will interest rates be on the rise in the future because of fiscal irresponsibility on behalf of the U.S. government? Let's talk about credit risk. Credit risk is essentially what are the chances that the issuer of that bond will not be able to repay it or default, in which case you would lose all of your money. Having discussed that, let's just take a peek here at what you might be interested in based upon your time frame and your level of risk. So say you need the money in 0 to 4 years and you have low interest rate risk. Well, what you're looking at again are CDs, treasuries, agency bonds, etc. Versus if you need the money in 10 years and you have high interest rate risk, meaning you're willing to take on that risk, well, then you may be looking at more risky products like preferred securities, emerging market debt, etc. Again, I'll let you stop the video here and take a peek at each of the details in these categories. Now, after you've run yourself through these first 3 categories, which may take a few hours, a few days, or even a few weeks, depending on what your situation is, you're ready to evaluate your opportunities and get invested. That's going to be the subject of the next few videos that I do, some of the opportunities that I see. The first of those videos is going to be long-term bond funds, because there's actually some action happening in long-term bond funds, and I think that there's still a lot of room to run there. 2 of those funds that I have been purchasing and what I'll discuss in the next video are TLT and EDV, in addition to other long-term bond funds. I hope this information was helpful for you. If it was, please give us a thumbs up. We need that for the channel, and we'd love to have you as a subscriber. Until next time, enjoy your investing.